All right, guys, so here we are in the last part of chapter 2, in a sense. Now we're looking more so into work in process. Okay, so you can look at the prior videos as we journey to this point, but what I would like to make sure that I make known to you guys is where we kind of how we got to this point really quick. So remember, you start off with some materials, right? And then those materials are then put into work in process, right, for that particular job, job number 71. So materials are put there, direct labor is put there, and factory overhead estimate. Very important that you say it's the estimate is put there. And then once the job is done, meaning we've applied all of the direct material, labor, and factory overhead, it is then transferred to the next phase, right? It no longer stays in work in process because it's finished, it's completed, right? And so then we transfer it to the next phase of the process. And that's what we're going to talk about now, okay? All right, so work in process. All right, so here's our work in process account. You see everything in here for all of the different work in process. Remember I said in the in probably prior videos when we were talking about work in process, I said that, hey, it's not really necessary that you every time you do a journal entry that you put in the job, because here you see they have already accounted for all of the different jobs and what belongs to what. Okay, so anyways, here's our work in process account. In the work in process account, you have job number 71, job number 72, and all of the information regarding each of the jobs. As I mentioned before, here's our direct material, direct labor, and factory overhead. So for job number 71, the total cost of that job is $10,250. And then for job number 72 is this $21,000. Okay. So as a job is completed, it is then moved from work in process to finished goods, right? We're no longer going to keep it there because it is a finished product. So so it says, how is the work in process account increase? Well, the way we increase it is by putting direct materials, direct labor, and factory overhead. And then the way after a job is completed in work in process, it is then transferred to finished goods. So we'll talk about what that looks like. But before moving on, I really want to spend some time talking about what a manager does with this information, this cost information, because it can be a very handy tool moving forward. So it says managers usually review manufacturing costs. So they look at the total cost of the job divided by the number of units produced to get the cost per unit. For instance, for job number 71, there was a total of 20 units, right? So the total cost of this entire job was $10,250. We divide that by the number of units that we produce, which is 20, and our cost per unit is $512. Now, this could be very useful for a manager because these are not isolated events in a sense. You can study this data and this information to help you control operation and cost going forward. For instance, let's say last year, in another job, there was 20 units of Jazz Series guitars. However, maybe the cost of making those guitars was, say, $325. Now, per unit, okay, per unit. Now, as a manager, if I'm reviewing costs, cost over time, I would want to know, hey, why has my cost per unit for the same type of Jazz Series guitar, why is it now close to $200 more, right? And so that's a point of entry where all of accountants and all of those people get involved, because naturally I want to know, why is my cost increasing significantly year over year? And so maybe some things that accountants would dive into, or whoever's on that team, hey, is my cost of, direct materials is the cost, right? Is my labor more expensive? Is my factory overhead more expensive? So it's a starting point to dive deeper into the problems or what's causing your cost to increase over time. Okay, so there's a lot of money to be made in that kind of analysis. It's called variance. You're studying management by analysis or exception, excuse me. So those are all things that you can study as a manager going forward. All right, so back to this point, we're talking about what happens once a job is completed in work in process, right? We've added all of the direct materials, the labor, and the factory overhead, and now it's no longer work in process. We've completed it. So now we're going to transfer it out of that account to the finished goods. And to do so, we're going to debit finished goods and we're going to credit work in process. Our work in process is decreasing, which is pushing those finished goods to a new account. All right, so let's talk about finished goods. So the finished good account houses inventory that was transferred from the work in process account. And so it says, when would the finished goods inventory account decrease? So when would our finished goods decrease? So hopefully you say when we sell it, right? So as soon as we sell our finished goods, that's when that account decrease. We're selling our finished product. So let's take, for example, during December, Legend Guitars sold 40 jazz guitars for $850 each, generating sales of $34,000. So they're showing you how they got that. And then the total cost of per guitar was $500 or a total cost of $20,000. So my journal entry to capture me selling this product to maybe my customer is a debit to accounts receivable and a credit to sales. And then I also have to capture the cost of goods sold. So remember accounting 1A, we had to recognize the cost associated with selling these 20 jazz guitars, right? Or sorry, the 40. So the way we're going to recognize that is our cost of goods sold and the credit to finished goods. All right. So last but not least, what we recognize is that when we sell goods to when we sell our product to the customer, there's a lot of people that's involved in the selling process. And those people are your marketing managers, your the sales guys, the accountants, all of the support, the administrators, the delivering team, all of those support functions that are helping that product take it from the facility to the final customer. And so in chapter 1, we learned about period costs. And so remember, period costs is those non-manufacturing costs. It is used in generating revenue during the current period, but not involved in the manufacturing process. And again, those examples include selling expenses, delivery, administration expenses, accountants, marketing, salespeople, so forth and so on. So here's what our income statement would look like. Again, just capturing the nature of everything that happened and putting it into a financial statement. But last but not least, I want to talk about job order costing from a service business perspective. While I did say this book focuses, or this part of accounting B mainly focuses on manufacturing businesses, there are some scenarios where we can apply this to service businesses. So, Disneyland, Tinder, oil companies, and things like that. Like, not oil companies, but I lost my train of thought. Moving on. All right, so if I'm decision making can be also used by for the service kind of service oil changing businesses. That's what I meant. So they could be used by service companies, just like that. They accumulate, similar to a manufacturing company, they accumulate and record costs by jobs. You can compare it to see why a job is more expensive than the other. You can also use cost evaluation and control. So why was more materials used? Why was less labor used or more labor used? So forth and so on. Okay. So with that, that's all I have for this chapter. Hopefully that made sense. If you have any questions, like always, just please reach out and let me know.